capital asset. So in India, capital gain taxation is quite challenging. Like there are different period of holding for different class of assets, and for different class of assets, there are different tax rates, and further there are some differences when the asset is non-wealth. So government is considering to, if there is any scope to simplify these decisions. This was the news 2 days back in Economic Times. We may expect some changes in the next budget, some important changes as far as capital gain taxation is concerned. Now we will discuss a specific section, section 112A.
Uh,
This
दीपक
this
जी
is
काफी ब्रेक हो रही है वॉइस.
so. Shall we move outside? Yeah, please.
हाँ, आई थिंक वो बेटर
You can
रहेगा.
move to the main rooms, yeah. Or if you
Yes.
want to change, I think that would be better.
Yes, please.
हेलो.
Just a second, sir. He's getting connected.
Going to discuss, dear participants, towards end of the session, we are going to talk about the most talked about deal of Adani and Holcim, which actually is the legacy of Vodafone tax. And this is going to be a very, very exciting understanding of the definition of indirect taxes. So, Deepak ji.
ईशा कॉल कर मेरा फोन फ्री है ना कॉल कर शाम
So, as we all know that this mega deal happened between Gautam Adani and Holcim. And Holcim is a company, Netherlands based. Indian assets. Yeah, Deepak ji, are you able to log in? So this last Sunday, Adani Group announced that the promoter family, through their offshore special purpose vehicle, which is based out of Mauritius, they have entered into a definitive agreement for the acquisition of Holcim's entire holding in Ambuja Cement and ACC. And this has led to a very big question whether this acquisition by Adani's, whether it will have to set aside a sum as withholding tax, exactly like Vodafone. So we are going to talk about this wonderful grand deal maybe towards end of the session.
On the transfer of such units. In this section, if we put long-term capital in this section, the benefit of the first provision and second provision to section 48 is not applicable. This is provided in third provision to section 40. So to compute capital gain under section 112A, there is a cost of acquisition methodology. Section 55(2) subclause AC is introduced for the purpose of cost of acquisition. If tax is payable under section 112A, cost of acquisition of equity shares, unit shall be calculated according to this. This provision is applicable only in respect of equity shares and units acquired by the cess before 1st February 2018. So when the section 112A was introduced, a grant was provided for all accrued till the date of announcement of this provision. How it will be calculated is cost of acquisition shall be first actual cost of acquisition. Second, fair market value of equity shares units on 31st January 2018, but subject to a maximum actual sale consideration of equity shares. Third is step 1 or step 2, whichever is higher. So your actual cost or FV as on 31st January 2018, whichever is higher, but your FMV cannot be more than sale consideration. So in this way, the gain accruing to 31st January, that is the announcement of this provision was grandfathered. That is your cost of acquisition shall be increased. How FP as on 31st January will be calculated is also given in Rule 3 of the income tax rules. It says in case where equity share unit is listed on any recognized stock exchange, the highest price of the share or unit on such exchange on 31st January is taken as FMV. Or if it is not, it was not trading on that day, the highest price on such exchange on a date immediately preceding 31st January when such share was traded shall be taken as fair market value. So after discussing section 113 long
Hello.
capital gain,
So yeah, anyone is
So I'm audible.
yeah,
Am I
yes,
audible, sir?
yeah.
yes,
So just what I have understood is I will like to repeat if you allow me, sir.
Yes,
So
yes.
so basically, section 112A, which I heard, is basically applicable on listed equity shares. Am I right, sir?
yes, yes. So this is applicable on listed equity shares or
Okay.
units equity or rent, and your
Okay.
sale should be after the April 2018.
Okay, sir. Okay. Thank you, sir.
So that means, suppose I am having those shares before 31st of January. What was the date?
That will be
2018.
covered under general provision of section 112.
Okay.
Yeah.
As on date, I need to take the fair value, and that will be treated as exempt. And thereafter, whatever gain is there. Uh, is there any example in these slides also regarding that?
So there is no example in this slide, but I can tell you, for
Yeah.
example,
Okay.
if your cost of acquisition before 31st January 2018 was say rupees 200 and FMV as on 31st January 2018 is rupees 275 and actual sale consideration which is after 1st April 2018 say 2nd April you sold the assets for rupees 300. Your cost of acquisition shall be taken as your cost, total cost that is 200 or FMV as of 31st January 275, whichever is higher, and that FMV cannot exceed rupees 300. So your FMV will be considered at 270. Right, sir?
Yes, yes. I think you have explained it with example.
Yeah.
Yeah.
So now we are discussing long-term capital gain. This is Journal Provision Section 112. For unlisted securities or share of a closely held company, there is a differentiation for non-resident and other assessing. For non-resident, tax rate is 10% without benefit of indexation and currency fluctuation. And for other assesses, this is umbrella of 20% with indexation. And for listed security, 10% without indexation or 20% with indexation, whichever is beneficial. And for any other asset, tax rate is 20% with index. Now, after discussing section 11 or section 112A long capital gain, this is section 1A short term capital gain tax. Short term capital gain arising transfer of equity shares of equity oriented mutual fund or business trust. If STT has been paid on such tax rate will be 15%. So in short-term capital gain, there is no journal provision. Like this is specific if STT has been, and if you talk about journal, if no STT has been paid, this will be considered as per your slab rates. So it will be added to your normal income and taxable at normal rate of tax. So now this some important provisions related to long-term and short-term capital gain tax covered under section AAA, 111A, 12 and 112A. In the case of resident individual or HUF, long-term capital gain taxable under 112 or 112A or short-term under 111A shall be reduced by unadjusted basic exemption limit. So, for example, a capital gain is 7 lakhs, the other income is rupees 1 lakh. So, my income is below taxation limit, rupees 50,000. So, in capital gain, the difference of 2,50,000 and 1 lakh will be given. Like taxable capital gain shall be used by that amount. Deduction under Sector 6A is not available from income arising all three sections. Rebate under section 87A is not available in respect of tax payable under section 112. This is very important provision in capital gain. Your surcharge can exceed 15%. Earlier, the 1A gain or 112A gain was covered, but with this Finance Act 2022, any long capital gain under section 112 is covered. So any gain arising in section 112, 112A or short term capital gain 111A will surcharge in tax exceed 15%. So now we will discuss a very specific topic, tax on joint development agreement. Section 55, Section 5A was introduced to give benefit to the landowners generally give their land for real estate projects for development of real estate project. It says where capital gain arises to an assessee being an individual or so this provision is not applicable to a company. From the transfer of capital asset, the land or building for both under a specified agreement, capital gain shall be chargeable to tax as income of previous year, in which completion certificate is issued by competent authority. So your gain will not be taxable in the year you enter into specified agreement or you hand it over the land to the developer. They will be taxable in the year if completion certificate is issued by competent authority. And stamp duty value on the issue of certificate as in by the consideration received in cash shall be deemed to full value of consideration received. This is definition of certified agreement. It is a registered agreement. So agreement should be registered in which a person owning a land or building or both agrees to allow another person to develop a real estate project in such land, building or both in consideration of a share, big land or building, both in project for the whole part of the project. And it may be with or without payment of the cash consideration. There is a provision also if the assessee transfer his share in the project on or before the issue of date of completion certificate, the benefit of this particular section shall not be available and gain shall be deemed to be the income of the previous year in which transfer takes place. That is, in which you enter into agreement or you transfer your assets to the developer. There is an example, for example, land is acquired tax on 10th April 2001 cost of rupees 5 lakhs. X entered into joint development agreement with developer on 1st March 2022. Consideration in cash was 20 lakhs, which is received 10th March 2021. Completion certificate obtained on 1st March 2022. In this arrangement, 60% of the construct unit was to be given to the landowner and 40% was to be retained by developer. And stamp duty value on the completion certificate is rupees 35 lakhs. 35 lakhs, 60% comes to 21 lakhs is to be given to the landowner, is X. So capital gain will be calculated in the hands of as follows. Stamp duty value on the date completion certificate is 21 lakhs. It will be added by consideration in cash 20 lakhs. Total full value of consideration is 41 lakhs. Cost of acquisition is rupees 5 lakhs with indexation benefit, but here is cash. Indexation benefit will be available only till the date when you enter into agreement. That is of year financial year 1920, 1st March 2022. So in this way, long-term capital gain will be calculated in joint development agreement. Now we will discuss employee stock option plan, which is called as stock. What are the employee stock options? An employee stock option plan is an employee benefit plan offered by a company to its employees. ESOPs provide an opportunity to employees to acquire stake in the company. ESOPs confer right, not an option. So this is right. You are not hired. It is not compulsory to take this right. This is entirely option of the employee. On the employee buy shares company at a future date at a predetermined date. So your price of the share will be decided and you can for this right. Apart from giving financial gains to the employees, ESOP also creates a sense of belongingness and ownership amongst the employees. The objective of ESOP is to motivate the employees to perform better and improve shareholders' value. So this is a win-win situation for employee as well. Employee gets financial benefit by this ESOP, and employer gets benefit that it gives a sense of motivational to the employees. They perform better in the growth of the company. So employers ESOPs are a tool to attract talent, also to retain and compensate. There are some terms related to ESOP. First is grant. Grant is when ESOPs are right of ESOP is given to you, but with some vesting conditions. This condition will be a continuous period of service for some years or any financial targets. Second is vesting. Vesting date is when you earn that. That is you fulfills the vesting conditions. So the difference period between grant and vesting is called vesting period. And last is exercise. Exercise is after fulfilling the obligations vesting already been done, and after that companies usually give some exercise period. That is period over which you can exercise your right. So the difference period between vesting and exercise is called exercise period. So you have already earned the, but still you have a choice for next 2 or 3 months. That is you can exercise your tax implications during exercise of ESOPs. ESOPs are taxable as perquisites in the hands of employees. Perquisites, salary definition of salary includes perquisites, and definition of perquisites includes ESOPs. This is given in section 17, subsection 2, subclause 6. The perquisite value is derived as the difference between the fair market value of the share on the date of exercise and the exercise price. Exercise price is the price at which you are given shares by the company. That is the price you have to pay to the to get these shares. So now discuss what fair market value on the date of exercise. For listed companies, the market on the exercise day is usually considered as fair market value, and for unlisted company, the fair market value is determined by category 1 merchant bank registered with SEBI. We have already discussed what is granting of option, what is vesting of option, exercising option, and transfer of shares. Granting means rate of agreement between the employer and employee to give an option. Here, no tax protection, that is, you have just granted the rights, you have not exercised your right. Next is vesting of option. On vesting, also, you just fulfill the conditions, you still not and you still have not exercised them. Third is exercising of. This is the date in which employee actually exercises the option and shares are allotted to the employee. On this date, taxability arises as perquisite in the hands of employees. And we have already discussed the value it will be calculated as fair market value as exercise price if and after allotment of shares, employee the option to hold or to sell, and if it is selling a few months of shares, capital gain will arise on the date of transfer of shares, the date on which employee sell the options in the market. It will be treated as capital gain, and capital gain will be treated as sale price as fair market. Fair market value means the value which is calculated as per Rule 52, which is considered for the calculation deposit. In these provisions, there was an amendment in financial 2022 since perquisite is considered at the time of exercise of and employer has to deduct TDS on this value. So to give benefit to startups only, this amendment was used in section 192 for the eligible startups only for the deducting of tax under subsection 1 by a person being an eligible startup responsible for paying any income to the assessor being perquisite of the nature specified in section 17 beginning after first day of April 2022 shall deduct pay as case may be tax on such income within 14 days. So deduction of tax was deferred for eligible start. So it will be within 14 days of first after the expiry 48 months from the end of the relevant assessment year or from the date of sale of such security by the assessor or from the date of the assessee ceasing to be an employee of the firm, whichever is best. So for example, if any employee already left the company before 48 months, the trigger point will be uh, there of deducting TDS, whichever is on the basis of dates in force for the financial year in which the said security equity share is allotted. But this provision was introduced for only eligible. Otherwise, for any other case, taxability arises in the year exercise only. This is the definition of startup as per section 80 IC. An entity is considered to be an eligible startup if it is satisfies the following condition. The startup should be incorporated as an LLP or company should be incorporated between 1st April 2016 and 1st March 2020. Turnover of an entity for any of the 5 financial years since incorporation should not exceed rupees 100 crore and it must hold certificate of eligible business. So now how to calculate FMV on exercise date? There is a formula given for shares if they are listed and traded on recognized stock exchange. Exercise date, average of opening and closing price shall be considered as market value on exercise date, the calculation perquisite. And if shares were listed but not traded on recognized stock exchange, closing price on the date preceding date exercise shall be considered be MV on exercise date. And if shares are not listed, price determined by merchant banker shall be considered as fair market. Now discuss how the ESOPs will be considered on selling. Capital gain will be sale consideration at less fair market value on the date of exercise. The capital gain tax treatment depends on the holding period, like already discussed. The holding period for consideration of long-term or short capital asset, and whether the shares are sold on a recognized stock exchange in India, taxation will be different. Fair market value on the date of exercise is taken as cost of acquisition. If the holding period is more than 12 months for listed securities, it is considered as long-term and attract capital gain as Section 112A. If the same is held for less than 12 months, it is considered as short-term and taxed accordingly. And if shares are unlisted or of any foreign company, short-term capital gain is taxed as per normal slab and long-term capital gain at 10% or at 20% after interest benefit. Example of tax
So that
implication of
means the price paid by the employee is not relevant over here for computing the capital gain taxation. That is
yes sir.
because
FMV
what you are saying.
exercise date will be considered as your cost of action.
Okay, yeah.
Yeah. Example of tax implication of ESOP for listed. The employer has given this is an example. Let's discuss. The employer has given the ESOP total of 400 shares for the next 4 years to his employees. But employee exercise price is rupees 100 and vesting period starts from 1st June 2020. The employee exercise 100 shares on 1st July 2020 out of 100 shares when the price of the share is rupees 500. Here price means fair market value of the share is rupees 500. He further sells these shares at rupees 1500 on December 1, 2000. So let's consider these are listed shares. Taxable value of it at the time of exercising is 500 less exercise price is 100 multiplied by number of shares 40,000, and employer will be deducting TDS as per applicable tax slab of the employee, say 20%. So TDS will be rupees 8,000. And now when employee sells these shares for rupees 1,500, he holds shares from 1st July to December 1 in 2020, less than 12 months. So this will be considered as short-term capital. Rupees 1,500 sale consideration less FMV on the date of exercise, rupees 500 multiplied by number of shares, rupees 1 lakh, the short-term capital gain taxable at the rate 15%. So 15,000 is the tax at the time of sale of such shares. What if stocks are of the company abroad? There may be a situation when any Indian entity uh, gives shares of its parent company as ESOP. Shares of a foreign company are considered as unlisted shares in India. Further, they will be disclosed as foreign assets in Schedule FA of the income tax form. So they'll be treated as unlisted shares covered under Section 112 if they are long capital gain. Assessee will have to pay 10% income tax on gains without indexation benefit or 20% income tax with indexation benefit. Short-term capital gain on unlisted will be added to the income and taxable as per salary. And on these shares, all the provisions of carry forward set off of losses are also applicable. Yeah, am I audible?
आपको
Hello.
ब्रेक क्या आ रही है? बहुत ज्यादा ब्रेक होके आ रही है.
Deepak ji, it's breaking in middle. Although we can decipher from the PPT, but it's not that clear to us.
Okay. Yeah, let me try.
Or else, Deepak ji, if you just want to switch off the camera, it might be consuming more of bandwidth.
Yeah, let me. Am I audible?
Yes, yes, Deepak ji.
Is my screen visible?
Not yet, Deepak ji.
Yeah, am I audible?
Yes, Deepak ji. Now even we can see the screen.
Yeah, thank you. So this is another type of employee share benefit plan This is called employee stock purchase plan instead of employee stock option plan. In this plan, employee share is shares are issued at a discounted price immediately as part of public issue or otherwise. Employee is required to contribute a small portion of his salary towards the scheme every month. Generally, there is a specific lock-in period from the date of allotment, unlike ESOP where there is no lock-in period as such. So, like we can see in any IPO coming in any company, like in Zomato, employees was given a right of ESPP, but with the lock-in period, and they were given a discount also. These are different from ESOP as there is an immediate purchase of shares and vesting is not required. Taxation is same for the valuation of perquisite as well as capital gain. The only difference is the value of perquisite is calculated as difference between fair market value and discounted price at which you purchase the shares from the company. Now, restricted stock units or RSU. RSU are shares of the company given to employee, generally high-end employee, key management personnel or directors, free of cost generally, but with restriction on selling. In these kind of shares, generally companies restrict selling of the shares, that is you cannot sell these shares for over some period of times. Taxation of these shares, when the shares are awarded to the employee according to the schedule, it is considered as perquisite income and added to the salary income. When one sells the RSUs, capital gain comes into play and one may have to pay tax depending on the period of holding. And companies are obligated to deduct tax for RSUs, and there are different methods of deducting tax. The most common method of deducting tax is share withholding, where the company withholds enough shares to cover the tax liability and deposits net shares only to your brokerage account. So to deduct tax, company withhold shares of assessee and use the proceeds of the shares to pay tax to the government and deposits only net shares to the brokerage account of the assessee. This option is called as sell to cover. Some companies permit other methods such as cash or same day sale transaction, which are explained further. Like we have discussed, a sell to cover is the default option where TDS percentage of the vested shares are sold immediately by the company and the amount is paid to the government as tax, and the assessee will be getting only the net shares in his brokerage account. Another method is same day sale. In this method, all the vested RSUs are sold immediately by the company. Percentage of the sale proceeds are deducted and paid as tax, and the rest of the money is deposited in the account of the assessee. So in this method, you will not get any shares. Next is a cash transaction, a cash exercise. This allows the assessee to pay tax and no shares are sold. The money to pay tax must be available in the brokerage account of the assessee. So in this option, assessee will be getting total number of shares. Whereas in sell to cover option, assessee will be getting net shares, and on same day sale transaction, assessee will be getting no shares. This is the major difference between all these methods. Now we will discuss what is stock appreciation right or SAR. As the name suggests, stock appreciation right is a scheme under which the participant, being director or any other employee, are entitled to receive cash on account of appreciation in stock prices. So you will not be getting any stock. The company will be giving only appreciation benefit of the stock of the company, subject to fulfillment of the certain vesting conditions. SARs are frequently awarded to employees according to a vesting schedule that is tied to performance goals set by the company. And after the fulfillment of such goals, the exercise period is allocated, within which the participants can claim the cash allocable towards their SARs. The cash to be paid as calculated is calculated on the base of difference of the price on the date of grant date and on the date of exercise date. So participants also receive the benefit of not having to spend cash to buy such stocks. Taxability from the perspective of the employee: at the date of grant of options, no income tax in the hand of employee. At the date of vesting of option, again no income tax in the hand of employee. At the date of exercise of options, same is the provision, like it is taxed as perquisite, but the difference between FMV on exercise date and grant date. So difference in money terms will be calculated as perquisite, and companies are obligated to deduct tax at source on perquisite income under section 192. And since there is no actual transfer of shares, there is no any further event of selling of shares, so no question of capital gain arises. So with this, I am done. I'm sorry there was so many disturbances due to some reasons. Thank you. If any question, please ask.